The broadcast is now starting. All attendees are in listen-only mode.
Good morning and welcome to today's webinar, What's Next with Secure 2.0, presented by our sponsor, Heffernan. We're so happy you can join us. My name is Michelle Wilcox and I will be your moderator today. And I will also be monitoring questions you have during the session. Before we open up the session, let's review a couple of key items. All of the webinar materials we discuss can be found on the URL currently showing on your screen. I will be sharing this URL in a follow-up email, so don't feel like you need to write it down right now. If you have trouble with the internet connection during the webinar, we recommend leaving the presentation and logging back in. We do not control the audio, your devices do. So if you have audio difficulties, try adjusting the volume on your settings on your device. If a telephone line goes down during the call, hang up and call back again at the same number. If all lines go dead, watch the on-screen chat box for an alternative call-in number. Feel free to ask questions or provide feedback by using the chat box or questions box during the webinar. If you're using a tablet, you may need to tap on the screen for the options bar to appear, and then you can select the appropriate option. We may not respond immediately, but we will work your questions or feedback into the presentation. If we can't get to your comment or question during the session, we will be online afterwards to respond, or we may follow up in an email if we run completely out of time. You may also email us at moderator@aspenrmg for up to 48 hours after the webinar. This is a 1-hour presentation. Question and comments are very much encouraged throughout, and the presenter will be answering questions at the end. And lastly, we have a number of upcoming webinars covering a variety of topics, including those listed on the Heffernan webinar website. With that, let's begin today's webinar. Our presenter today is Andy Larson, with over 35 years of experience in the services industry. Andy is a respected authority, frequent lecturer, and author on industry topics. Andy's background includes managing and consulting with major record-keeping platforms, extensive product design for plan sponsors, and advanced sales support for intermediaries who work with plans. As a retirement industry executive, he ran the record-keeping and consulting practice for the Universal Pensions Incorporated and headed the BISYS Corporate University. He has served as an adjunct professor for the Central Lakes College System in Minnesota and provides expert witness services on numerous industry topics. Andy is a co-author of RLC's book, Retirement Resource Guide, Essential ERISA Education and Best Practices for Financial Advisors. He is a graduate of the University of St. Thomas in St. Paul, Minnesota, and maintains a certified pension consultant designation from the American Society of Pension Professionals and Actuaries. Thank you for being with us today, and I'm going to go ahead and turn the presentation over to you now.
Thank you very much, Michelle. Appreciate the opportunity to chat with you about quite a big topic, and we're gonna be getting through a lot of material. But before I do that, Michelle, I clicked a little bit of a technical thing here. I want to make sure my screen is sharing.
It was, and then you were on the top. So whatever you just did, there you go.
Just bear with me here a bit. Are you seeing the presentation?
I do. I see the front slide, the beginning.
Unfortunately, I am not. So.
Uh-oh. How about
hitting escape to try to get that minimized? Maybe I'll just turn my camera on.
I was just going to say, why don't you try that? See if that fixes it. And you are in presentation mode, correct?
I do have my presentation up. There we go. Okay, sorry about that.
That's right.
We're going to be talking, obviously, about the Secure 2.0 bill today. And what I'm not going to do is I'm not going to read you about 50 slides. I've discovered that most attendees would rather not have the presenter read about 50 slides to them. But I am going to cover some high-level issues first before we get into the slides. And the high-level issues are three of probably the most significant elements to Secure 2.0 that organizations are going to have to make decisions regarding. And these three big ticket items are matching of student loan payments. Secondly, Rothification, that is participants having the ability to elect to pay taxes on some of their employer contributions now and have those dollars moved into a Roth bucket. And thirdly, emergency savings accounts. These are really the big ticket items. Student loans matching, Rothifications, and emergency savings accounts within the auspices of the plan. Now, it is sort of embarrassing as a speaker to have to tell a group who's here wanting to know about Secure 2.0 and specifically to know about the big ticket items, how these are going to work, how these are going to transition. And the short answer is, we don't know. We don't know because much of the Secure 2.0 bill was very sparse. And to fill in the blanks, Congress directed the IRS and to a lesser degree, the Department of Labor to sort of fill in the blanks. And unfortunately, they haven't. And to be fair, these are big initiatives, big efforts. It's going to take some time. So unfortunately, while we don't know the details of most of these big ticket items, despite that, I think there is maybe a good thing in this delay because it's going to give plan sponsors and plan committees time to consider whether they should be utilizing these features. And that's what I'm going to start with first at a high level, just kind of give you some insights in terms of what we're hearing and what we're seeing with plan committees and plan sponsors. And I spend a lot of time with plan committees, do a lot of work with plan governance. So I've had, opportunity to talk to committees and meet one-on-one with committees from Florida to Anchorage, Alaska. So let's start with the first one, and that is the notion of the ability to match student loan payments. And folks, there's a tremendous amount of misunderstanding here. Matching student loan payments doesn't mean that the employer, that you all use the matching contributions to help make student loan payments. No, not at all. Matching student loan payments, when this goes in effect, will work like this. A participant will make student loan payments somehow, some way, we don't know yet. They will notify you or the record keeper that they've made student loan payments. And then you will make a matching contribution to the plan on behalf of that participant, just as though they would have made a deferral. So the student loan payments, if your organization elects to do this, and it is optional, if you elect to do this, your organization will match into the 401k plan based on the student loan payments made by that participant. Clearly, this provision is very popular amongst a certain segment of the population, obviously the younger individuals with significant student loan payments. And where we've seen plan committees interested in this is those industries, number one, that are hiring individuals that have student loan payments, commonly in the, for example, in the IT space. But also, I've seen a lot of organizations very anxious to start matching student loan payments. And why would certain organizations be anxious to do this? It has to do with the labor market. We all know what the labor market is like today. It's tight. It's difficult to get good workers, and it's increasingly tough to keep them. So what we're seeing is organizations really using their, or planning on using their 401ks offensively to help with the recruiting and the retention function. I never thought I would see that. Let me give you an example. A couple of months ago, I was in the Denver airport, and there was signage all over the Denver airport promoting that a certain airline was matching 9.2%. They were using that as a recruiting tool, using matching, a generous match, as a recruiting tool. That surprised me. Subsequently, I had a contact that worked for that airline, and I talked to them in more detail, and they are eager to start matching student loan payments. So where does this leave us as a plan sponsor, as a plan committee? Keep in mind, matching student loan payments is optional. Thus, if you are hiring or trying to hire individuals that typically have student loan debt, if you're struggling in the hiring and retention area, I would urge you to consider using some form of student loan matching. When can you start doing that? The answer right now is unknown. We still need IRS regulations. We still need the record keepers to ramp up for that. My guess is it will be at least first, if not second quarter next year, but that's just a guess. So your first takeaway from this event, if you are struggling hiring individuals with student loan debt, and your labor market in your area is difficult or tight, contemplate student loan matching as an offensive strategy to help with the staffing situation.
Andy, we have one question. Somebody wants to know, would the student loan matching contribution be similar to 401k on the participant only side? They could pre-tax put the money in a plan to use to get reimbursement for their payments?
Interesting approach to that question. The student loan payment is actually nothing more than the current student loan payment methodology, where if I, Andy, have a student loan and I make a payment to my student loan, the processing agent for my student loan, that processing agent then forwards it on to the holder of the loan. The student loan dollars never touch the plan. They never get into the plan. They're completely separate from the plan. What will happen is the IRS will prescribe some method where the participant alerts the plan sponsor or the record keeper or the TPA that the participant made X amount of student loan payments to a third party and request matching on those amounts. So the student loan dollars do not flow through the plan. Excellent question.
Somebody else is asking, would the participant need to make loan payments instead of 401k contributions or in addition to?
Oh, now there's an interesting question. Could a participant make student loan payments and get matched and make regular or Roth deferrals and get matched? Presumably, yes. Presumably, the matching is available both on student loan payments and on deferrals, subject to the plan's, matching caps that the plan may have. So yes, and I suspect you'll see this. I suspect many participants will be making deferrals and get a match, and be making student loan payments and get a match. So yes, I think that's very likely. Other questions?
Looks like somebody said, when you say match, does that mean that the employer contributes the same amount as the participant?
When I say match, does that mean the employer contributes the same amount as the participant? No, not necessarily. Each 401k plan has its own matching formula. Some 401ks match dollar for dollar, 100% match. Some 401ks match 50 cents on the dollar. Some match 25% on the dollar. So whatever your matching formula is, that same matching formula would be applied to the student loan amounts. So if your matching was 100%, and I made a $2,000 student loan payments, I'd get $2,000 match. If your matching formula was 50 cents on the dollar, and I made a $2,000 student loan payments, I'd get $1,000 match. So you simply apply the plan's matching formula to the amounts of the student loan. Any other questions on that one?
Yeah, we've got another question. Will the student loan payment be considered part of the federal limit toward deferral amounts?
Oh, my. Whoever asked that one, I commend you. Very thoughtful question. Let me back up just a step. As most of you are aware, there's overall limits on the amount of deferrals you can make into the plan. There's different limits, but typically it's around $20,000. The question is, how does the matching contributions, excuse me, I misspoke. Do the student loan payments offset or reduce the amount of deferrals, or do the student loan payments offset this limit, this $20,000 limit? The answer is we don't think so. So would it be possible to make student loan payments and maximize the employee deferrals of about $20,000? Yes, we think so. And does that mean that a participant could potentially double dip on matching? No. Plans will be able to cap the matching at the overall deferral limit. So the short answer to the question, we don't think student loan payments will offset or reduce the participant's ability to make deferrals.
Somebody wants to know, can these contributions be subject to a vesting schedule?
Can matching contributions be subject to a vesting schedule? And the answer is yes. 401k plans can impose a vesting schedule on the matching dollars. Now, if your plan is using, for example, a safe harbor feature, then the matching is going to be fully vested. But there's nothing, if you're not in the safe harbor arena, there's nothing that precludes you from using a vesting schedule with matched amounts for student loan payments. Else on that one?
So since we're still on this topic, somebody's asking if there's no matching for the employer, there's no matching on the student loan. Is that correct?
If the 401k plan does not have a matching contribution, then there is no matching on student loan payments. Correct.
Okay, and then one last one. Can you review again about where the employer's student loan match dollars go?
Certainly. Let me walk through the process from the start, and I'll use myself as an example. So let's pretend that Andy makes $5,000 of student loan payments throughout the year. Those checks or those ACH amounts from my bank account go directly to the student loan processor, whoever that is. Somehow, and this is what we're waiting for the IRS on, somehow I will notify the employer and or the record keeper that I've made $5,000 of student loan payments to my loan processor. The record keeper will then alert the plan sponsor to say, hey, in your next remission of match, add X amount for Andy to reflect the matching on the student loan payments that he's made throughout the year. You then, as a plan sponsor, when you submit your next contributions, would then send that amount in to the record keeper, and those matching contributions would show up in Andy Larson's 401k matching account. That's how we think the process is going to occur. Okay, well, excellent job on questions. Let's go to the next big ticket item. And if you're taking notes, I'm going to have you write down one word, and the word is Rothification. Rothification. And this is pretty much a simple concept. And here's what Rothification is. Rothification allows an individual with employer contributions in the plan to elect to pay taxes on those employer contributions and have those amounts then moved into the Roth account or the Roth bucket within the 401k plan. Let me give you an example. Let's say we've got a participant with $1 million in a 401k plan, and we'll pretend they've got $400,000 of employer profit sharing contributions. That individual can take, again, we don't have the final regs yet, so we don't know if there's limits on the amounts. But let's say that they've got $400,000 in the profit sharing bucket, the profit sharing account. And that individual elects to pay taxes on $300,000 in the current year. Ostensibly, a 1099 would be issued for $300,000. That would show up on the individual's 1040. What would then happen is the record keeper, excuse me, would change their records, and you would see on your statement $300,000 leaving the employer profit sharing account or bucket, and instead being placed into the Roth bucket. Now, this is significant because once those dollars are in the Roth bucket, the earnings, the growth, the future increase, when that comes out, will all be tax-free. That's why an individual would consider Rothification. And here's the issue, and we're seeing this a lot, and maybe you know individuals like this. You're seeing individuals with large balances of qualified money in 401ks, maybe 403bs and IRAs. If you've got someone with, $1 million plus in a 401k, really what they're doing, and let's just use the $1 million number. If someone's bringing $1 million in a 401k into retirement, they don't really have $1 million. They've got to pay taxes on a portion of that. So depending on their tax bracket, they go into retirement with a tax and unpaid tax liability. That could be a $250,000. So think of it this way. If you've got a large balance in a plan, a large amount, you have an unpaid liability on your personal balance sheet going into retirement. Therefore, in the accounting profession, there's getting to be CPAs saying to clients, you know what, you and your spouse are both working, you're earning a lot of money, let's Rothify some of this. Let's pay some taxes now. Let's take some tax off the table. Let's reduce your future required minimum distributions. Let's pay it now, convert it to Roth, and then start ramping up our tax-free income in retirement. That's why a firm or an individual would consider Rothification, to pay some tax now, to draw down their required minimums at a future date. This provision also is optional. Plans don't, or plan sponsors don't have to offer this. However, if you have higher net worth individuals in your plan, individuals making, high incomes, and even, let's say, younger, middle working age individuals with big balances, these individuals are precisely the ones that should be looking at potential Rothification. Because the more you Rothify, the more you draw down that tax liability that you have when you enter retirement if the amounts are not Roth. So what type of firm or organization would consider Rothification? Clearly medical practices, law firms, dental practices. These are organizations that I've seen consider Rothification. But as I've noted, we don't have the rules yet. But as a plan committee, I think you should be considering, does the profile of our plan make sense to offer this? Because, the downside is it does add to the complexity of the administration of the plan. Questions on Rothification?
Andy, we don't have any questions right now, but many people are just wondering, and I believe you mentioned it at the beginning of the presentation, that you weren't going to go slide by slide. So they just want to make sure that you knew that you were still on the initial one.
Yep.
That's what I thought. Okay.
And what I'm about to do, now I'll go through the slides. And as I promised, I won't read them. I'll cover key points on some of the slides. But if I skip something, please send a question into Michelle, and I'm happy to go back and cover it.
Thanks, Andy.
All right. Just a quick note, the Secure 2.0 came about through the consolidation of about a dozen different bills. It was passed just about unanimously in Congress. So next time someone says, Congress can't get anything done, heck, they passed this monster with just about unanimous consent. So that's a plus. Some of the key themes is they wanted to expand coverage, they want to increase retirement savings, and from an administrative side, they're trying to simplify and clarify some of the rules, which I think they've done a good job. Kind of some key provisions. We've got some additional credits for new plans. There's even additional tax credits available for plans that add, auto-enroll, and auto-escalate. So the tax credits for startup plans have been substantially increased. So the 2023 credits are noted here. I'm not going to go through all the details here, but it does make it worthwhile for, I think, organizations to look at plans. Also some provisions effective in 23. Some simple issues. It allows aggregation of accounts for required minimum distributions. If the individual has an annuity and a plan account, they can combine those for required minimum distribution purposes. Lastly, one that may impact participant or plan sponsors or committee members, if you overpay a participant, you no longer are required to attempt to recoup the overpayments. Recouping overpayments is now optional. The IRS and the DOL have extensive correction programs. If you have issues or problems with a plan, the correction programs we found to be very effective, and we found IRS and labor to be very good to work with. They've expanded that program, which I think is good news for us as plan sponsors. You'll see a change in the hardship rules. The employees may now certify the hardships exist. You don't have to do any investigation. So self-certification is now permitted on hardships. And there's some changes for self-employed and sole proprietors, allowing them to make deferrals for the first year of their 401. Some other provisions, some changes to free the penalty tax for firefighters and public safety employees. They extended the age 50 rule to private sector firefighters. Again, that doesn't affect a lot of people. And a lot of these provisions, again, are significant for a narrow industry. It expands the tax-free disbursement amounts for public safety officers to pay health and long-term care premiums. And it allows an extension of the early withdrawal penalty exception for public safety officers with at least 25 years of service. The 2023 provisions, the first one there is Rothification. That's Andy's word for it. And that's the top issues. If you've got a defined benefit plan, assets from overfunded pensions can be used to pay health and life benefits. And tribal governments can also can issue domestic relation orders in a divorce. So small change there. Again, as I mentioned, changes to the required minimum distribution calculation. The good news thing is that the penalties have been reduced for required minimum distributions from 50% penalty down to 25%. And if it's timely corrected, the penalty is only 10%. There's additional exceptions now in early distributions from plans for individuals with terminal illness, and required minimum distributions are pushed out to 73 and eventually out to age 75. Modifications, required minimum rules for special needs trust, some legal statute of limitation issues for excise taxes on IRAs, and 10% penalty exceptions for federal disaster payouts. I'll turn it back to you, Michelle.
Okay, great. So the penalty for failure to take an RMD, it's changing from 50% to what percentage? First answer is 5%, 20%, 25%, or 40%. And everybody is doing a poll right now, so I'm going to wait until it gets to be about 75% voted. And thank you, everybody, for your participation. It's greatly encouraged and appreciated. Let's give it just a couple more seconds here. So it looks like we've got a mixed bag, but 65% say 25%, 18% say 20%, 12% say 40, and 7% say 5.
Okay, the correct answer is C, 25%. Remember, it was 50 and it went to 25, so it's 25%. Okay, for now we go into the provisions that go into effect next year. There's some changes in the contribution rules for simple IRAs. The deferral and catch-up amounts are increased. In 2024, the plan cash out limit increases from $5,000 to $7,000. This is the amount if the participant leaves, you can force a disbursement on that participant. Starting also in 24, there's a new kind of 401k plan called a starter 401k. It's an automatic enrollment plan, very simple plan, not a lot of extra options or features, but it comes into effect in 2024. Also in 2024, we have starting the availability to offer emergency savings accounts into the plan with a $2,500 cap. We don't have any details on this or how it's going to work. These emergency savings accounts would be part of the plan. There'd be an auto enroll amount. They would be matched. The key thing is to remember with the emergency savings account bucket, it's kind of a Roth, and employees can take that money out whenever they wished for whatever purpose. The idea behind this was helping families accumulate, obviously, emergency savings. How many plans are going to adopt this provision is unknown. We're going to need to see what the regs look like. Some other provisions in 2024, I've already talked about the student loan payments. An interesting one is a plan in 2024 could permit a participant who self-certifies they experience domestic abuse to be able to take out up to $10,000 from their plan. Again, this is an optional provision. You'd want to discuss this, obviously, with the plan sponsor and the committee. Other plan provisions, pension plans must provide additional information comparing annuities versus the lump sum option. Another provision in 24, it eliminates required minimum distributions from the Roth amounts in 401ks. Currently, there's an odd thing. If you have a Roth and a 401k, you've got a required minimum. If that was the same dollars in a Roth IRA, you wouldn't have a minimum. They're just lining those up. Also, they're liberalizing the beneficiary rules in 24. The surviving spouse may elect to be treated as the deceased employee for required minimum distribution purposes. Other provisions, this gets back to my earlier comment about simplifying some of the administration. They've extended the grace period to make some corrections if there were errors in auto enrollment and auto escalate. So if a plan sponsor forgot to enroll or forgot, the penalties were pretty significant. Under these new rules, you get a grace period of 9.5 months after the year to fix that. I think this is a really positive thing. All right, Michelle, you're back on.
All right, so the question is, new 401k plans must include an auto enrollment feature after what year? 2022, 2023, 2024, or never? And Andy, while I'm waiting for everybody to cast their votes, we have a question asking if you could talk a little bit about how this bill affects simple IRA plans.
Absolutely. Basically, this bill does two things with Simple. Number one, it increases the contribution limits available under Simple IRAs. Number two, it allows them to be terminated during the year as long as that Simple IRA is replaced with a 401k. Right now, you can't terminate a Simple IRA during the year. You've got to do the notice in November, and then you can terminate the plan at the end. Starting next year, this will be liberalized, and you'll be able to terminate a Simple during the year if it's replaced with a 401k.
Great, thank you. Okay, it looks like we have majority people voted, and it looks like 45% says 2024, 34% say 2023, and the 18% says never, and 3% says 2022.
Okay, this is a horribly messy little rule. The short answer, the right answer for the test is 2024. Starting 1/1/24, every plan has to have an auto enroll feature. Every plan has to have it. It was very unclear in the legislation that that's what the intent was. But starting in 1/1/24, all plans have to have an auto enroll. All new plans must have an auto enroll feature. Okay, now we'll start getting out into the future a little bit. For 2025, you see a special new catch-up limit. And this catch-up limit for plans is the greater of $10,000 or 50% or more than the regular catch-up limit. And this is only for people that are 60, 61, 62, or 63. As an example, let's say we have a 60-year-old who in 2025 made the regular deferral limit, plus they kicked in 9,000 of higher catch-up. What that means is then in future years, when they're 61, 2, or 3, they've only got $1,000 left. So effectively, this higher catch-up limit is an extra $10,000 in total. And they could do it $2,500 a year, 60, 61, 62, 63, or all in 1 year, potentially. This goes into effect in 25. Another provision in 25 is it reduces the 3-year eligibility rules to 2 years for long-term part-time employees. So as you may be aware from Secure 1.0, employees that have been there for 3 years and earn at least 501 hours have to be allowed in the plan. Well, this 3-year eligibility of 501 hours starting in 25 is going to go to 2 years, and you have to let them in the plan. So if your organization uses part-time employees that typically work under 1,000 hours a year, pay attention to this. This is going to be a big deal when this goes into effect. Okay, moving to the real future, 2026, it permits plans to distribute up to $2,500 a year to pay premiums for long-term care insurance. And these payments are exempt from the 10% penalty. What our friends in Congress was trying to do is get people to start thinking about long-term care and allow dollars in qualified plans to be used to pay these premiums without that being considered a distribution subject to penalty. Now, again, we've got some time before this comes into play, but I think we're going to see more of this, and it's something that maybe by next year you'll want to be talking to the plan sponsor and the plan committee whether or not this provision is going to be, you're going to consider this provision added to your plan. The next one at the bottom, I kind of chuckle at this one because we're sort of back to the future. Unless a participant elects otherwise, DC plans such as a 401k must provide a paper benefit statement at least once annually, and the DB plan must do so every 3 years. Kind of the idea behind this was really the increase in missing participant situations where someone leaves with a balance and you can't find them. And the hope is that if we're sending out paper statements, they might remember that they got these dollars and be less likely to forget or leave these balances behind. But that goes into effect in 26.
Matthew, we do have a couple questions.
Yeah.
Somebody asked, what does auto-enroll mean? They said, as an employer, we have to automatically enroll our employees. What if they don't want to be?
What does auto-enrollment mean, and what happens if they don't want to be? Auto-enroll means if the participant does nothing, if they don't sign any forms, if they don't go on any websites, they will automatically participate in the plan at a specific date, automatically then log their participating plan at a certain level of deferral, 3, 4, 5, 6, whatever percent. They can, however, unenroll. They can opt out. But to opt out of the auto-enroll, they have to do something. And something could mean go to HR, go to payroll, sign a form. Something could mean go online, go to the plan website, click a box, certify online, and then opt out that way. But basically, if nothing happens under auto-enroll, if nothing happens, if the participant doesn't do anything, they're in the plan, and will be deferring X amount. And X is what you get to decide in your plan document. Now, if someone doesn't want that, they fill out the form, they go online, and then if they've already had money go in, then they can elect to take a distribution, okay? A distribution. That's what auto enrollment really means.
Great, thanks. Somebody else asked, does the Rothification option apply to IRAs or simple plans or only to 401ks?
Question is, does Rothification apply to IRAs and simples or only 401ks? Only 401ks.
Great, thank you.
Now, I'd like you to take a look at the bottom of this slide. This is a biggie. This is huge. This is gigantic. And no one's told you about this. Starting in 27, many of our participants in our plans are going to get a new contribution. They're going to get a contribution not from you, all the plan sponsor, not from themselves as a deferral. They're going to get a contribution from Uncle Sam. And this is called the Savers Match. And most of us are familiar with the Savers Credit. It's a credit on their 1040 now. Starting in 27, there will be a Savers Credit that can be deposited to the IRA or the qualified plan. So what's going to happen is, this will apply to a lot of moderate and lower income employees, that this credit, and Treasury is going to be pushing this because public policy wants to augment retirement savings. This is going to get pushed. So what this means is, at some point, your plan is going to get plumbed and wired into the Federal Reserve System. So starting in 27, these dollars can come into your plan. This is a huge deal. It's going to be significant. Again, we're a few years off, but starting in a year or two, you're going to want to be talking to your TPA and your record keeper about the Savers Credit coming into your plan in terms of the Savers Match amount. Now, we don't have any details other than pretty much what you're looking at here in terms of how that's going to work and what if there's an error and are there penalties and whatnot. But this is a big deal starting in 27. Keep your eye on it. Okay, Michelle.
Okay, the last question. Starting in 2033, RMDs must commence by what age? A, 59 and a half, B, 65, C, 72, or D, 75? And again, while I'm waiting for the votes to come in, another question. Somebody says, we have interns aside from our part-time employees. Would this apply to them as well regarding the long-term PT provision? We currently exclude interns from participating in our plan.
Okay, do interns count when it comes to the long-term, long service part-time employees? Yes, interns count as long as A, they're paid, and B, they've got more than 501 hours of service.
Great. Let's put in one more here. Does the new plan for auto enrollment refer to a new employee's plan, or does it refer to new plan set up by an employer as the plan sponsor?
Okay, when we talk about the required auto enrollment provision, what does that apply to? That does not apply to existing 401ks. That applies to auto enrollment is going to be mandatory if there is a new plan set up in 24 or beyond. If there is a new plan, existing plans do not have to add this. Only brand new plans.
Okay, great. Are there any salary parameters around the Rothification?
Are there salary limitations on the Rothification? No. And a lot of people ask that. As many of you are familiar, there used to be limits on salary caps on using Roth. This doesn't apply here. In fact, the government wants people to Rothify because they want people to Rothify because government will get tax revenues sooner than if they leave those dollars in qualified accounts that will be taxed. So from a public policy perspective, we, the government, wants Rothification because it accelerates tax revenues.
Great. Is the provision for the Roth catch-up of 10,000 for people 60 to 63 required, or is it optional?
Is the optional catch-up provision of an additional $10,000 required, or is it optional? That is optional.
Great. Okay, getting back to our polling, it looks like we've got 48% says 75, the age of 75, 32% says 72, 10% says 65, and 10% says 59 and a half.
Okay. In 2033, required minimum distributions must start at age 75. They're currently at 72. Okay, let's move on. Some other provisions, and I can cover kind of all of these in a general comment. Some of you, many of you may have seen these wonderful new acronyms, MEP, PEP, or GOPs, or groups of plans. Let's talk about what this is for just a minute. Right now, most organizations sponsor their own 401k plan. However, you can, in lieu of sponsoring your own plan, sign on with sort of a group plan. And all of these are group plans. And for purposes of our presentation today, MEP, PEPs, and groups of plans are all the same thing. They're all the same thing. They're multiple employers signing on with one plan. As an example, we've worked with a couple of states where the state dental associations set up a group plan and the dental offices can sign in. And there are going to be more of these. Kind of the jury's still out in terms of how popular they are. But what's happened with the bill is it made some changes. It changed the fiduciary rules to limit kind of fiduciary liability to the key plan sponsor. MEPs and PEPs can include 403B plans. Startup credits are available to these plans. There's only a need for a limited audit in some of these plans. But these are just the changes to MEPs and PEPs and groups of plans made by Secure 2.0. A lot more to this and beyond really the scope of our presentation, but there are changes out there. 403B provisions. This is kind of government. It's kind of funny. The bill allowed 403B plans to offer what's called collective investment trusts to the participants. In some cases, these are less expensive than mutual funds. But while the tax code now allows it, the SEC rules still prohibit collective trusts in 403Bs. So the bottom line is 403B participants still can't invest in collective trusts. A surprising common sense thing at the bottom, starting next year, the 403B rules for hardships are going to be identical to the 401k hardship rules. We'll no longer have two distinct sets of hardship rules. Simple provisions, I've mentioned this already. The allowance for Roth, increased contributions, and allow for Roths to be replaced or simples to be replaced mid-year. There's provisions, changes for ESOPs that are kind of subtle, kind of beyond the provision of the focus of us on this session today, but there were some ESOP changes going into effect in 28. Defined benefit changes be changes in how cash balance plans operate, specifically the interest crediting rate for the participants can be on a market rate basis. The variable premium methodology for PBGC coverage is changing, changes to the mortality rules, and additional funding requirements also going into effect. Plan amendments. At a high level, start keeping track of how and what you're going to be changing, because it might be 2, 3, 4, 5 years from now before you physically have to amend your plan to conform to what you decide to do. So keep a file on your committee meetings. If you decide, for example, to elect to match student loan payments effective this date, document that. So in 2, 3, 4, 5 years, when you're actually doing the plan amendment, you'll have the details of what you did when. So plan amendments won't be coming for a number of years out. The challenge for committees is in 26 or 7 or 8 or 9, remembering what they did in 23 and 24. Keep track of that. DOL and IRS homework. As I mentioned at the start, here is the homework assignments for the IRS and the DOL to flesh out Secure 2.0. They are going to be busy, and this is why we don't have a lot of the detail yet, because of the homework assignments. Some other provisions, some clarification on IRAs, expanding the qualified charitable deductions up to $50,000 is available. Allows a limited rollover capability from 529 accounts, indexing the IRA catch-up amounts. A lot of peripheral stuff that I'm not going to skip into now. If anyone has a question on this, just reach out and we can discuss it. And that's the summary. Again, I'll just close where I started. The two big provisions you want to start talking about is matching student loans and the possibility of Rothifications. That's getting and getting attention, and we'll get more. So with that, I'm going to turn it back to Michelle.
Great, thank you, Andy. There was a lot of great material that you shared, and we appreciate it. We have a couple more questions just here in closing, since we have a few minutes left. Does the Rothification apply to 403B?
Rothification 403Bs, I believe so, yes. Yes, again, we're waiting for that kind of detail, but I believe 403B will be included.
Okay, somebody else had a question about our our 403B plans affected, and should we interpret 401k as 403B?
Not necessarily. It's usually a good bet, but we should wait until we get regulations.
Great. Lastly, who decides on the waiting period for a new employee to join a simple IRA plan? The employer, or is it regulated by law?
There are eligibility requirements under the simple. It's usually called the 3 of 5 rule, that the individual has to work at least in 3 of the preceding 5 years to be eligible. That's the maximum. You could do 2 of 5, you could do 1 of 5, or you could let everybody in immediately. That's up to the plan sponsor.
Okay. Somebody asked if our plan renews on 1/1, can we add the student loan match later, mid-year, or when it becomes an option?
Can we add the student loan feature at a date other than the first day of the plan year? While we don't explicitly know the answer to that, I strongly suspect IRS will let us add that mid-year, yes.
Okay. Does matching student loan apply to 403B as well?
Could matching be applied, matching 403B side, on the 403B side? Potentially, yes.
Okay. And then one last, if creating Roth plans, will they be required to have the same max contribution cap as a 401k plan?
Probably the caps will be the same, yes. I strongly suspect they'll be the same.
Great, thank you so much today for being with us, Andy, I'm sorry. Thank you all for attending today's presentation. by Heffernan. We will send the information by email with instructions on how to access a copy of the presentation on our website. Thank you, Andy, and to Joseph for your time and expertise today. We hope all the attendees found today's webinar to be a valuable use of your time. Be sure to join us on October 3rd for our coaching skills for supervisors, getting employee performance and behavior improvement, one meeting at a time. Thank you all and have a great day.
Thanks, guys. Bye-bye.